Welcome to Yahoo Finance's special coverage of the August CPI report. I'm Julie Hyman. The key inflation report just crossing the wire here and coming in, at least on the headline number, slightly hotter than estimated. Month over month, 0.4% gain in August on the headline. If you strip out food and energy prices, volatile food and energy prices, you get 0.3%, which is right in line with estimates and also unchanged from the prior month. The year-over-year number at 2.9%, also in line with estimates, and the core year-over-year gain of 3.1%, also in line with what economists had been estimating. So seeing some heat there on the headline number. We'll have to dig into the components here and figure out exactly what was contributing to that. But it doesn't seem like here, at least at first blush, that there was anything that would dissuade the market from its currently pretty firmly held view that the Fed is going to cut a quarter point at its meeting next week. You see futures here holding on to some modest gains. Remember, of course, we saw record closes again yesterday for the S&P and the NASDAQ, so we could see an extension of those gains here today. So again, just quickly recapping the numbers, seeing a 0.4% gain in August consumer prices month over month. If you strip out food and energy, you get a 0.3% gain, which was in line with estimates. And we're seeing, for the moment here, in terms of reaction in the markets, we've got equity futures still pointing to a little bit of a higher open here. We'll see if we get any volatility as we get a little bit of a digestion of and looking through the numbers again to see kind of what we saw from the components. So that's what we have on the face of it here. We want to break down the numbers a little bit further here. Joining us now to discuss in more detail, we've got Joe Brusuelas, RSM Chief Economist, Collin Martin, Schwab Center for Financial Research Fixed Income Strategist, and Claudia Sahm, New Century Advisors Chief Economist. Guys, I've just now opened up the components to try to go through and see where we saw some increases. I'm sure you guys are all doing the same in real time. Joe, I'm going to go to you first. I see you looking. I can tell you're looking at the numbers here. I'm curious what stands out to you in your sort of first blush reaction.
All right, so we were coming in a bit hot in the service sector. That's really what's driving the data. That's what drove the 0.4% top line growth. I mean, I'm looking directly at this right now. Even shelter came in a bit hot. So what we're seeing here is that, yes, you're going to get your rate cut out there in trading land. But I got to tell you, the underlying tenor of the data here doesn't suggest that it's a lock that you're going to get 3 rate cuts before the end of the year. If you're a hawk on the committee and you're looking at this, okay, you'll sign off on the rate cut next week, primarily due to the signaling at the Fed and market expectations. But the deeper you dig here, it doesn't look so good. It looks to me like service sector inflation is not just sticky, but it's going to be stubborn. And the Fed's got a lot of heavy lifting to do in front of it to get back to 2%. Anytime over the next couple of years.
And Claudia, I want to go to you on this because I find a little irony in this current inflation trajectory because we were all waiting for the tariff feed through. And yet the sticky components that we're talking about, at least on the face of it, don't seem to have to do with tariffs. They rather seem to have to do with relatively strong consumer demand. Is that the right way to read it?
Well, I certainly would point to some of the service sectors, which we don't think of as being as tariff impacted as, say, the goods areas. But it also gives a good context. We went into this year with inflation still elevated, and that elevation was coming from these service categories. And we've just made really slow progress on moving them back to pre-pandemic, in line with target kind of pace. And that's just, that's been a theme, not just of this year, but also of last year, frankly. So it's really more the context of where we came into this as opposed to, I think, some, special new feature, like, we've been thinking a lot about how tariffs are affecting right now.
So I guess, Claudia, I would follow up and ask, what is the market is taking as a certainty that the Fed's going to cut. Are there risks in the Fed cutting into this inflationary environment?
They're absolutely a risk. And we heard that from Chair Powell at Jackson Hole. The Fed is moving into an easing cycle, and I fully expect them to cut by 25 basis points next week. But it is an easing cycle where they are balancing the fact that there are upside risks to inflation, and that might, as Joe said, get them to pause. Like, this might not be a consecutive set of cuts. And then they have these downside risks to employment. So it's the worst kind of setup for the Fed, because the two sides of their mandate are in conflict in terms of what should you do with interest rates to address them. And today's report, the CPI, it's still too firm, right? Like, this is not consistent with making progress towards 2%. So when they cut next week, they will not be cutting because we have good news on inflation. They'll be cutting because we have bad news on employment.
And speaking of bad news on employment, by the way, I just want to flag another economic release that we just got in the past few moments. That's weekly jobless claims. We don't necessarily always pay as much attention to them, but we saw that jobless claims number at 263,000 last week. That's the highest since 2021. So in keeping with some of the other numbers that we've been getting. Collin, let's bring you into this. We've been talking about what the Fed may do the rest of the year based on these numbers, based on the jobs numbers, and we've been talking about the market expectations. Do you think, the market's probably not going to be disappointed next week, but then what? What are we seeing in terms of what's being priced in?
Well, I'm in full agreement with Joe and Claudia, so maybe it doesn't make for the best programming, but I share the same concerns in that the Fed's mandates are in tension right now, and I don't think we want to get away from that fact. We fully expect a rate cut in September, and as we look to the end of this year, at least one more. We say at least one more because we're expecting two, and then we'll see how the data plays out. Looking ahead, though, the Fed funds futures market is expecting and projecting a sub 3% rate by the end of next year. And we find it difficult to get on board with that, just given where inflation is right now. I want to piggyback on what Claudia was talking about. Inflation is still elevated. It's been elevated, and it's moving in the wrong direction right now. And if we go to comments from Fed Chair Powell about how they want to approach that sort of situation and judge, based on which of their mandates might be farther away from their goal, even though we're seeing a weakening in the labor market, a 4.3% unemployment rate isn't too far from what they expect over the longer run. But 3% inflation is well above their 2% inflation goal. So I think they will ease gradually. But we're only looking at 2 this year, and then we'll have to see how the rest of the data plays out. If inflation does come down, which there doesn't appear to be too much evidence that it will anytime soon, if it does, that will likely open the door for that consistent path lower. Until we see that data, though, we're a little bit more cautious.
Something else I'm struck by in the data is that we continue to be left with this economic background that is not a good setup for lower income Americans. For example, the food at home price index up 0.6%, right? The shelter index, as we've been talking about, which goes into services, up 0.4%. So, Joe, that seems to be not a good backdrop. On the other hand, with stocks continuing to reach record highs, the wealth effect is alive and well. So do we continue to get that bifurcation, and what are the effects of that?
Well, those are the perils of the American K-shaped economy, aren't they? It's very difficult to make policy judgments based on that big economic inequality. Guys, as I look at the data here, I got to tell you, the pre-market consensus that this was all going to be all about services, well, it's partially true. But when I see apparel prices jump by 0.5%, those are tariffs. When I see food prices jump, given the composition of the North American food supply chain, that's tariffs. Moreover, when you see demand for discretionary services jump, we saw a 5.9% increase in airfare prices. That's not really where you want to be just before you're going to start a rate cutting cycle. I got to tell you, I run 4 models, formal models that look at in order to estimate the optimal policy rate. Not a one of them are signaling rate cut right now. I firmly believe we're getting one, but we're really going to be cutting rates into rising inflation here, guys. And this is not exactly where one wants to be. And then finally, Julie, down market Americans are the ones who are going to be shouldering the burden of adjustment. And that's one of the reasons why public sentiment just remains so sour. just look at those food prices. After we get off, I'm really going to do a deep dive into food prices and see where they're located. And my sense is, you're going to see tariffs written all over that.
Well, let's talk about the vibes a little bit. We haven't talked about this in a little while. We talked about it a lot last year, where we were talking about this sort of vibe session, where people were unhappy, even though the economic numbers looked relatively good. Claudia, what are we like in terms of sentiment versus reality right now? How should we be thinking about that, especially given that last year we saw those big downward revisions in jobs? So I don't know if the vibes were correct at that point then, if that's the way to read it.
Yeah, we've seen over the course of this year some real movements in consumer sentiment. Like in the spring, things really hit the floor and there was a lot of pessimism, and we've seen some improvement. But I will say recently, I think the thing that stuck out to me in some of the household surveys is being a lot more downbeat about the jobs market. Right. And it's important to put all these pieces of data together. We look at inflation, it is still running higher than it had been before the pandemic. You can make up for a lot of that in terms of just, making ends meet as long as the labor market is really working and wages are growing quickly. But we've seen wage growth slow down and, job prospects are not good. So like that, you can come at it, and then that's a piece of the sentiment as well. So I think we're still not in a particularly good place, but looking at a lot of the measures that we look at in sentiment, it also doesn't look like a falling off a cliff, like the kinds of what we see going into a recession. This has been kind of a slog.
It does, yes. It does. It's felt like a slog, that's for sure. Let's bring it back to the markets a little bit more, Collin, with you, and the sort of range where we have seen the 10-year, for example. We've been seeing it sort of start to move below that range recently. What do you expect both into and beyond the Fed cut?
Yeah, we're not convinced that long-term yields, like the 10-year yield, will fall much further, even in the face of the expected rate cuts that should come next week and later this year, mainly due to the inflation that we've all discussed. Inflation's still high, and if it's expected to stay elevated, I think there could be that risk premium embedded in that 10-year yield, that investors want to keep it elevated to compensate for those potential upside risks. We're also worried about fiscal concerns. And whenever I bring that up, I always want to highlight that, we've looked at it over the past, number of decades, and we haven't really found much of a relationship between budget deficits and debt outstanding, debt relative to GDP, and what that means to treasury yields. But we worry that at some point a relationship could form, given that the trajectory, continues to be up. And at some point, you might need to see yields stay elevated, maybe increase a little bit to attract that marginal buyer, especially when we're in an environment where, global bond yields have drifted up a little bit, making them a little bit more attractive for investors across the globe. So, kind of summing that up, we don't think that 10-year treasury yields will necessarily fall sharply from here, absent a recession. If we do see a significant slowdown in economic growth or even a recession, we'd probably see the 10-year fall maybe to that 3.5% or lower level. Absent that, we think it might kind of stay range bound and maybe even drift a little bit higher, given those inflationary and budget concerns.
And that's really interesting, Collin, that you bring that up, because maybe not obviously, but can we extrapolate what you're saying about the 10-year to the 30-year as well? And then sort of what are the implications for all of those people out there who are waiting for mortgage rates to come down?
Yeah, unfortunately, we don't expect mortgage rates to come down much further, and that's something we hear a lot. And we talk about with our clients at Schwab that the Fed doesn't control mortgage rates. Long-term yields, 10, 30-year treasuries are more influenced by inflation expectations, the growth outlook, and long-term Fed expectations. And given what I just said, we're not expecting long-term yields to fall much further, and therefore we're not expecting mortgage rates to fall much further, which unfortunately won't provide that relief that I think a lot of people are hoping for the housing market.
Guys, something that we have talked about previously, but we haven't talked about yet today, is the independence of the Fed and that ongoing issue, right? We've had some developments since we've last caught up in terms of the attempt to fire Lisa Cook, her fight back, the presumed confirmation of Stephen Myron and his participation in the Fed meeting next week. Joe, what's your current thinking around these issues and kind of how that could, listen, we know the Fed's independent, but we know they're human beings. And there's a lot going on around all of this. And you're going to have potentially in that meeting room someone who's being attacked by the administration facing off against someone who is a representative of the administration. I mean, how should we be thinking about those dynamics?
Well, I think that the Fed's independence has been eroded. And I think that we just need to call it as it is. It's one of the reasons why you see that yield curve steepening. We think it's a bear steepener where the front end of the curve continues to fall, but you see yields rise at the long end. As we move into that, investors are going to be looking at action between the 5 and the 10 year and the 10 year and the 30. The only takeaway that I get from that is that investors are beginning to take seriously the attacks on the Fed. It looks like the Fed is moving away from its official 2% target. When you talk to market players, people who've got real money on the table, they're telling us that, they think the effective target's around 3% now. That's a very big change.
Do you think, Claudia, that once there is a new Fed chair that they would make that change official?
So I would disagree that the target has changed to 3%. I think again they're balancing off risks of higher inflation and lower employment. So but it is absolutely the case that if you look at inflation over the last couple of years, it's settling in much more close to 3% than 2%. So point well taken in terms of outcomes. I don't think that's where the Fed is going. My biggest concern is the outcome of Lisa Cook's case. And I think we really could get some information before this next meeting if she's allowed to stay on and, as her case proceeds as a governor, if, the judicial system really pushes back and is like, no, for cause means something, this isn't just at will, then, that's going to be really important in terms of making sure that you have a Federal Open Market Committee that has some buffer from like short-term politics. And that's something that really hasn't been in question for a very long time. So there may have been some erosion of the Fed's independence. There's certainly been a lot of political pressure, but we are nowhere near the bottom of where this could go in terms of really losing control of monetary policy.
Julie, can I just break in one more time here?
Yes, briefly.
I think that I'm really interested to hear what Claudia has to say on this, because I think that, does the Fed have the credibility to cut into even a one-time increase in the price level? Is their credibility so entrenched that they can do that? And I'm wondering about that right now, because when you see the erosion of their independence, right? Everything rides on inflation expectations and the Fed's credibility. And if it's going to be further eroded, that's just setting the stage for persistent inflation. And I'm having a hard time moving away from that. And I understand exactly what Claudia is saying about the Fed's not going to change their official target anytime soon. But if the market thinks the effective target is 3%, that's what's just as important.
All right, I got to put a pin in it there. Guys, thank you so much. We will definitely continue this discussion, especially as Claudia says, if we're at sort of a fulcrum and things may be getting worse. Fingers crossed. All right, thanks, guys. Coming up, we'll have more on the August CPI report next on Yahoo Finance. Well, we just got CPI numbers, consumer inflation rising 0.4% month over month. But if you strip out volatile food and energy costs, where we saw a pretty substantial increase, you saw 0.3% gain, which was in line with estimates. All of this not seeming to dissuade investors from the view that the Fed's going to cut rates next week. Let's take a look at the market reaction in more detail now. For that, we go to our Jared Blickery. We'll look at the movers on the back of that report.
Well, thank you, Julie. Let's take a look at the world indices that we have. Futures are on the left here in the U.S., and we see the Dow, S&P 500, NASDAQ, and Russell 2000 futures all in positive territory, but they were already in positive territory when we got the report. For instance, here's the Dow, and here was the initial reaction. It was to the downside off the report, then it recovered, and we now happen to be at session highs, at least since midnight. And then if you take the S&P 500 up 0.25%, it's also making new highs, and the NASDAQ will do that as well. Very similar boat. And if we take a look at the bond market, and we might actually hit the dollar first, so let's take a look at the dollar. Dollar went down, and that's not surprising if more rate cuts are getting priced in. By the way, I was looking at the at the Fed Fund futures, and those are implying 3 rate cuts by December. It was a little bit less than that, but now 3 are fully baked in by December. Of course, that changes day by day, but it's interesting to note. I haven't seen that level in quite some time. So that's the dollar. Let's take a look at what's happening in the bond market here. 10-year T-note yield, that is now down to 4%. Have not seen this in quite some time. Let's go to a year to date. Really, it's matching the level that we saw in March, and that was a low for the year. So this is really new territory, at least recently, for the 10-year. 30-year, this is the lowest now. It's down 2 basis points, lowest since April or May as well. And then if we take a look at the 13-week T-bill yield, because that tracks what the Fed is doing on the short end of the curve, and remember the Fed acts on the short end, very near-term maturities as opposed to the long end, which is what we were just looking at, that is making new multi-year lows. That is down 2 basis points to 3.91%. And by comparison, the Fed is keeping interest rates above 4%, short-term rates above 4% right now. In a range, and so this is material. This is the market pricing in those rate cuts, not only in September, but October and December as well. Here are gold futures. Let me get, this is a year to date, 37, 38%. That's impressive. I'll get to the intraday. We shot up after the report, came back a little bit, but still underwater, down about 1/3%. And I like to track Bitcoin as well. It looks like we were down, we were up a little bit, but really pretty low volatility there for Bitcoin and cryptocurrencies. And let's now look at some of the sector action. This is what happened yesterday. Tech was leading, XLK up 1.81%. Now I'm going to put on the overnight and the pre-market quotes. You can see healthcare up 62 basis points in the upper left. That is leading. Tech is number 2 now. And we can see winners on the top row going all the way down to XLP. That's Staples up 9 basis points on the right. To the downside, we have energy leading down. That's crude oil is off 1 or 2% there. Also communication services, a slight drip. And I'll just leave it on the Dow here. We got NVIDIA, we got chip stocks, we got the mega caps largely surging in the pre-market. Julie?
Thank you so much, Jared. Appreciate it. Let's turn now to a closer look at the categories in the August CPI report. Yahoo Finance senior reporter Ali Canal is here now. Ali, as we saw, the headline number saw the bigger increase. Food, energy, also seeing some substantial increases.
Food and gas, which we really saw softer in July, which is why we had some of that relief, but the opposite happening this time around in August. So if we start with that headline figure, you're going to see that the food index increased 0.5% over the month. Food at home rose 0.6%. That's the food you get from the grocery store, so a sticky number there. And the food away from home saw an increase of 0.3%. Now, if we take a look within some of those food categories, you're going to see some of the steepest increases in things like coffee, fruits and vegetables, meats, rice. Again, these are basic essential items that Americans shop for all the time, and that's where a lot of consumers have said they are feeling most squeezed. So that's important to emphasize here. Now, gas prices, another thing that consumers are exposed to. They had seen a significant decline in July, but gas prices were up nearly 2% in August. But here's the good news in some senses is that services, that's sticky services inflation that we saw last month, that did reverse in certain categories. So we saw medical care services, that was down 0.1% after a 0.8% rise in July. Recreation and communication services also decreased last month. However, we did see airline fares rise 5.9% over the month after rising 4% in July. So it's not all services that are seeing this reversal of that acceleration that we saw in July. Other indexes that rose over the month include used cars and vehicles, new vehicles, as well as apparel. And apparel is one category that we often look at when it comes to the tariff impact, how tariffs are filtering through the system. Apparel rose 0.5% in August. This was stickier than July, although footwear did see some decline. So if we take a look across the board for categories, it's really a mixed picture, but this complicates the Fed's path forward, especially on top of that, we had jobless claims coming in at a 4-year high. So you combo that, you take a look at CME Fed futures, the odds of a 50 basis point cut have now increased.
Interesting. Thank you so much, Ali. Appreciate it. We got much more Yahoo Finance coming up on Morning Brief. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Julie Hyman. Let's get to the three things you need to know today. First up, the closely watched CPI report out this morning. Consumer prices rose 2.9% year over year in August. When you strip out volatile food and energy prices, the figure showed inflation coming in at 3.1% year over year. While the data did come in largely in line with economists' estimates, it's still well above the Fed's 2% inflation target. Separate data showed us initial jobless claims jumped to the highest level in almost 4 years. And stock futures, little change following the print. Investors still largely pricing in a Fed rate cut at the central bank's meeting next week. Rate cut hopes have kept the major averages at record highs. The S&P 500 posting its longest streak of gains this month, closing higher for 3 days in a row. The benchmark index also getting a boost, of course, from Oracle after its forecast reignited the AI trade on Wall Street. And Klarna seeing a strong start to its public debut. The buy now, pay later firm seeing shares climb as much as 43% in its first day of trading after pricing at $40 per share. The shares slipping a little bit this morning. Next up, we've got the Figure IPO. The blockchain-based lender raised $787 million in its initial public offering, valuing the company at $5.3 billion. Make sure to stick with Yahoo Finance because at 10:30 a.m. Eastern, we're going to sit down with the co-founder of Figure ahead of its public debut. Let's get a check now in on stock futures. We are seeing modest gains across the board here. Remember, we could see future record closes again for the S&P and the Nasdaq, each of which are indicating gains of between a quarter and a third of 1% this morning. The Dow futures also pointing higher as we got that CPI report that basically confirms investors' hopes for a rate cut next week. Let's dig further, though, into our top stories of the day. The August CPI report showing inflation mostly in line with estimates, but slightly hotter than expected month over month. Meanwhile, markets continuing to price in a Fed rate cut next week, plus stocks continuing to trade near records after the S&P 500 closed at another all-time high. Joining me now, senior reporter Brooke DePalma live at the Nasdaq, Fed correspondent Jennifer Schonberger, and Morning Brief Market Sunrise host Ramzan Karmali. Thank you guys for being here. So Brooke, Jen, I want to start with you. And I'm used to starting with Brooke. Let's start with Jen because we got CPI to talk about this morning. So Jen, what's your read and what's your first blush reaction on seeing those numbers and the implications for the Fed?
Yeah, hey, good morning, Julie. Inflation is still very much sticky, right? We're sitting around a full percentage point above the Fed's 2% target, but I don't think it kicks the Fed off course for a rate cut next week. And I think we do see 25, not 50, right? Taking a quick look at those numbers, the core measure, which excludes volatile food and energy prices, which is the preferred way that the Fed likes to look at inflation, that clocking in at 3.1%, in line with expectations and holding the same level for July, though month over month, a little bit hotter, up 0.1% more than expected at 0.4 versus 0.3. The headline also perking up to 2.9 from 2.7. But if we look at what was driving this, it was a little bit on the core goods side, but we also saw services there. So, inflation sort of holding sticky. Again, I don't think it takes the Fed off course, but I think the bigger news perhaps of this morning was the initial jobless claims numbers, those coming in at a 4-year high of 263,000. And this is important because this is a coincident indicator. It's more of a real-time read on the job market versus the monthly jobs report we get from the Bureau of Labor Statistics, which can be a lagging indicator. When you start to see jobless claims tick up, that's a sign of deterioration in the job market. And so we know the Fed is grappling with both sides of its dual mandate, both inflation and jobs. And Chair Powell said during his speech in Jackson Hole last month that the balance of risks are shifting when he opened the door to a rate cut. And so I think the Fed is right to focus on the labor side of their mandate here. I don't think it pushes them to do a catch-up cut for 50 basis points next week. I mean, we'll see. But it's clear that if the job market is continuing to deteriorate, you're really not going to have an inflation problem going forward.
Yes, although obviously you got a lag there in terms of people losing jobs and the price dynamics. Brooke, let's talk about what's going on in the market here this morning. It doesn't seem like there's anything that's derailing the continued record high push.
Yeah, markets seem to be largely shrugging off this latest proof of price persistence that's really coming in effect of those tariffs really driving up, especially those food prices where the supply chain has been largely impacted by the implications of tariffs. And if you take a look at the YF Interactive, we do have the futures up. And if you take a closer look right now, what we're seeing is essentially when that report came out, when it hit at 8:30, we did see the Dows fall slightly. And also as well, we saw a similar move with the S&P 500 right there. And then if you take a look at the NASDAQ, it was a similar reaction there as well. Once that report hit, we did see futures fall just slightly, but now we see all three, the Dow, S&P 500, and the NASDAQ moving higher. And what exactly is really driving that is I want to take a closer look at what really led the tech rally on Wednesday, and that was Oracle. And Oracle is yet again expected to open higher. If we take a look at extended trading right now, Oracle is up about 1% in pre-market rally. And we're hearing from so many experts and strategists on the street that Oracle really gave proof to investors of this bullishness around tech. Jose Torres of Interactive Brokers saying that this propels confidence that the tech-fueled bull market has further room to run. And that's really what we're seeing here. Investors largely shrugging off this report already with the price, rate cut already really baked into this market. And we're seeing futures move higher this morning yet again, really leading to perhaps another day of record highs.
And Brooke, one little detail that you noticed in the CPI report that I thought was interesting to bring up, you're watching the price of canned fruit and veggies.
Yeah, well, what we saw in this CPI report is that canned vegetables and fruits for the month increased about 0.5%. Now, food inflation, food at home, increased about 0.6%. And this is rhetoric that we've heard over the past quarter in earnings call. Campbell's CEO pointing out that if we go back to Section 232 tariffs, 60% of our tariff gross impact is coming from the steel, aluminum tariffs. And so I just thought that was a really interesting anecdote that these canned fruits and vegetables, because perhaps of those aluminum tariffs, is causing prices to drive higher, something that we've been watching to look out for.
Now, while we are very focused on the Federal Reserve here in the U.S., obviously, Ramzan, you are focused on what central banks are doing in Europe as well, and the ECB in particular. What is their trajectory like versus what we expect from the Fed?
So in the past sort of 45 minutes or so, the ECB have decided to keep rates on hold at 2%. The Fed might be, we all expect the Fed to cut next week. ECB on hold, you might think, oh, well, they're probably behind what the Fed are doing. But in fact, no. In fact, between June 2024 and June 2025, get this, the ECB have cut rates 8 times and halved rates to 2%. Why? Because unlike the US, inflation, according to the president of the ECB, Christine Lagarde, is in line with expectations. It is at around 2%. And in fact, though the ECB didn't give any hints about what they might do in the future to interest rates, they did say that one point that's quite crucial to note here is that actually they expect inflation in 2027 to actually go below 2%. So there might be a chance of even more easing. So it's a totally different picture in Europe than it is to the US, where inflation, it seems, is under control and in line with target, whereas in the US, inflation is perhaps a little bit more stickier.
Yeah, interesting and good perspective because as we know, the Fed is also watching what's going on around the globe. Guys, thanks so much. Brooke, Jennifer, Ramzan, appreciate it. Coming up, we're going to count you down to the opening bell on Wall Street. Don't go anywhere. You're watching Morning Brief on Yahoo Finance. Now time for some of today's trending tickers. We are watching Opendoor, Kroger, and Centene. First up, we got Opendoor. Those shares are surging after the company said co-founders Keith Raboy and Eric Wu will rejoin the board. The company appointed a new CEO after Kerry Wheeler abruptly stepped down last month. The company, which buys homes online, was at the center of the meme stock frenzy in July after hedge fund manager Eric Jackson laid out his bull case for the stock. Next up, we got Kroger. The grocery chain's comparable sales and adjusted earnings beat expectations during the latest quarter. The results driven by higher sales of fresh food, e-commerce, and pharmacy. The company also raising its full-year sales forecast as value-seeking consumers are opting to eat at home. And Centene, the health insurer, affirming its adjusted earnings per share guidance for the full year. Shares jumping after the insurer said early data showed its Medicare quality ratings are in line with the company's expectations. It's a positive sign for the company's turnaround and a sign of relief for shareholders as well, because the stock has been hammered. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, stocks are poised to open higher as the August CPI report seemingly cementing investor expectations the Fed will cut rates next week. My next guest, though, warns not to mistake this market momentum for actual optimism. I want to bring in Alex Morris, FM Investments CEO and CIO. Hey, Alex, it's good to see you.
Julie, it's good to be back.
So this is something I talked a little bit about with Tom Sosnoff of Tasty Trade yesterday. He's concerned about froth in the market, and he pointed out that it's sort of a buying begets buying sort of situation, or to put it another way, momentum. But why do you think it is not supported by actual optimism? How do you tell the difference?
Well, I think the real optimism would be we see a lot of better things happening, right? We're looking at rate cuts because we see not that we've declared mission accomplished on a soft landing, but rather because the jobs market is starting to waver, right? We do see a lot of signs of hitting a top in many ways, but there's just so much money that has been sitting on the sidelines that it has to go somewhere. And traditional says when rates start to come down, equities should go up. So we're seeing a lot of classical market trends happening, but none of them seem to be really buoyed by a great shared sense of morale across the country or the world, or all of these other metrics that are just really hitting new highs, other than the equity market, which again seems to be the byproduct of this result, not the thing driving it forward.
I mean, Alex, I could play devil's advocate and say, who cares? Does it matter, right? In other words, you could argue this has been the case for a little while. How long can something like this continue?
Well, and you're absolutely right. The quote we've been using is the Big Lebowski, that's just like your opinion, man. And that seems to be right, is we could be right about all of these things and the underlying causes for them, but sitting on the sidelines entirely has been a bad trade. Now, that said, sitting on the sidelines has earned a pretty good cash rate. So, sitting this out has been a lot less painful than perhaps 5 or 6 years ago, where you earned actually nothing or maybe lost a lot of ground as inflation picked up. But you're absolutely right. Whatever the underlying metrics may or may not be, the rally has been sustained, and it does seem like for at least the next little while, we will get a 25 basis point rate cut, it feels like, in a week, that it's still good to be in the trade. The question, though, is when is it time to start to ease back or pull out? When can you no longer participate and not feel so badly about it? And we think that that moment is now and starting to come, will become more important in the coming weeks.
Okay, so if the moment is now that you're starting to sort of retrench a little bit, what are the potential, and if there is already sort of headline risk that's out there that the market's shrugged off, what are the candidates for the thing that the market will not be able to shrug off?
Well, it seems like there's two sort of counterintuitive things. One, although credit spreads are really trite, we do think there's a great opportunity in the middle part of the curve and in the credit space where you'll be rewarded pretty well, because most companies still have pretty healthy balance sheets. They've been good stewards of debt and capital. We think there's a lot of opportunity there. And the one thing you can't get out of the way of, and it will sort of push equity markets a little higher along the way, we acknowledge, is the AI revolution is real. We've been talking about it for a long time. But if you just look at the sheer capital going into it, the enthusiasm and honest enthusiasm behind it, perhaps dependence behind it now, that is absolutely going to continue to roll forward through this year, through next year and beyond. And all of this, though, is predicated upon the fact that we're hoping we don't backslide into a couple of hot wars and a few other geopolitical factors that we haven't spent a lot of time talking about recently, but are really should be on the front burner of a lot of investors' minds.
Yeah, we haven't seen geopolitics on the front burner of investors' minds in a long time, it seems like. Or if it is for a day, and then it kind of fades away. What would be your argument for, what would a scenario look like that would make it more of an investing risk?
I think we need to see a response from the EU, NATO, the US over incursions into Polish airspace. That story, got headlines for a short while and then sort of moved on for other political issues in the US, for as terrible as they are. But I think you're going to need to see some actual response there. We're going to need to see either a complete lack of solution in Ukraine or in the Middle East, or some action. We just had President Xi sit down with Supreme Leader Kim and maybe acknowledge North Korea as a nuclear power for the first time ever. So there's a handful of these things that are just on the edge of happening that feel like we're really approaching that tipping point. It's going to really require some U.S.-led action or some EU-led action to try to either seek resolution and not get it and decide they need to take a new direction, or actually find resolution, perhaps positively, and then give us a fresh breath of wind to go forward and up from here.
So, Alex, given all of this, and going back to what you said about now being a good sort of inflection point for your portfolio strategy, what does that look like?
We've been beating this drum for a long time, and we're going to stay true to form, which is diversification is your friend in these moments, right? Liquidity is key. Being well diversified is key. It's hard to really call the tops and the bottoms, and you can always see them when they're in the rear view, and they look pretty clear when you know exactly what was going to cause it. But the solution is to be happy with accepting you're not going to hit the highs or the lows, but just trying to stay somewhere in the middle. The 60-40 portfolios had a great return. We think that makes some amount of sense. We also think if you're worried or if you're starting to look over the horizon, now is the time to really think about how do you manage your portfolio for taxes? And then how do you manage to make sure you have enough cash and inflation protection cash to look after your lifestyle and your needs going forward? Because as we see wealth shifting into spending mode and sort of out of just net savings, that other part of how do I assure I have the capital I need to pay off the bills I want to pay in the future or acquire the future expenses I'm going to bring on becomes much more paramount.
And then I know you have some strategic ideas or even tactical ideas within fixed income as well. Rates will come down. We did talk to a fixed income strategist earlier who said rates may come down, but they might not come down as much as people think. What's your view on that?
I do think we're going to see a little come down the front end as rates do naturally come down from the Fed. I don't think we're going to see the curve just flatten out back to zero. I think that's, some hope, mainly by folks who are hoping to refinance their mortgage at 2%, which isn't going to happen. We do see some risk in the long end, not just the steepener trade that's popular today, but which does seem to make some sense, but long-term rates actually ticking up as the government has been underfunding the 10-year and on notes and bonds, and probably does need to get out of this habit of just refunding the government in 90-day, 180-day, and 3-year and in debt. So as we see that move, there's going to be some change in those rates. I don't think it's going to be dramatic. We are happy to see mortgage rates come down pretty markedly over the last 6 months, 12 months, but we still think there's some risk there. And there's some opportunity for the Fed and the Treasury to either execute this soft, if not perfect landing at some level, or to give the game away at the very end. And jury's still out on what's going to happen for the next little while. Jay Powell is very clear on where he's trying to go, but as we've seen, that he will not be the only voice in the room very soon.
True enough. Alex, thank you so much. Appreciate it.
Thank you.
Coming up next on Yahoo Finance Opening Bid, Executive Editor Brian Sozzi joining us now. Soz, what are you focusing on today?
We're still continuing that monster story that is Oracle. I still can't believe how much that stock rose 35% yesterday. We're going to dig into what that means for the next generation, or iteration, I should say, of the AI trade. Also focusing on Figure with that company's IPO on deck for today. Raised almost $800 million in capital. Big raise for them.
Yeah, another big IPO today. Looking forward to that and looking forward to your interview with Figure. Thanks so much. We'll see you in a second there, Soz. That does it for Morning Brief. Much more ahead on Yahoo Finance.